Hello there, I'm Mark Sebastian, the founder of Option Pit, and this is Trading VIX, our emergency webinar on what I am trading right now. So I want to remind everybody that this is for education purposes only. This isn't legal advice or anything like that. It's just meant for education. So treat it that way. So who am I? My name is Mark Sebastian. I was a trader on the floor for about 10 years. After I left the floor, I started Option Pit. We are an education and consulting firm. We work with retail traders and professional traders and help them become really good professional traders. Everybody we work with, we want to become a pro. We want them to be the best trader that they can be. And thus, we are very much we cater to an audience that if you want to become a real trader, a good trader, somebody that wants to make money and not just at this for fun, right? We want trading to be fulfilling for you and profitable for you, but not just a fun little pastime. So if your goal is to actually make money, that is what we are about. We've got a bunch of my students in here, along with a bunch of people that aren't my students. And I'm sure, students, feel free to drop an endorsement in the chat. We do a pretty darn good job of teaching people how to trade. So what are we going to cover today? I'm going to basically talk about what is VIX. I'm not going to talk about spikes today. I'm going to talk to you about some strategies for trading and things that I am doing and looking at right now. I'll show you a trade that I just got done doing. It's closed primarily, and why it worked out so well. And then I'm going to maybe talk to you about some things that I like for the next week, and hopefully, and at the end, I'm going to make you a pretty good offer. And I know that we'll pay for it with some of the ideas that I think I'm coming with right now. So the most important thing to understand about volatility is that a stock can go anywhere and stay there. And volatility can go anywhere. It can, but it just doesn't stay there. It will mean revert. And that's really the key. So, mean reversion is the key, and that is what really counts for traders. And that's how we're trading VIX. So understanding how the mean reversion works and how we can take advantage of it is really the key. And then, that's going to help us make buy and sell decision and hedging decisions. And the number one thing is that a lot of traders think mean reversion is going to be instantaneous. It's going to happen in a short period of time, but it can stay bid for a very long time. In 2018, we saw volatility stay bid for 5 months. In 2019, it stayed bid for, end of 18. Beginning of 19, it stayed really expensive for about 3 or 4 months, and then it eventually dropped. So I think the important thing is not to have what I call a recency bias. We all tend to do that. We tend to think, and VIX really trades that way too, that what recently happened matters more than kind of the history, and it doesn't. What's recently happened is the same as everything else. So don't let what's just happened affect, vol's low, it's going to stay there forever. Vol's high, it's going to stay there forever. It doesn't work that way. It moves in waves. We teach guys about zone trading. What zones are we currently trading in? So just real briefly on the VIX, VIX is the SIBO volatility index. Purpose of the index is to gauge the buying and selling of options on S&P 500. Right? So is there more buying or selling in the S&P options? I like to say it gauges the cost of insurance. So when there's more buying of options than selling, vol is going to go higher, VIX is going to go higher. When there's more people selling vol, well, then VIX is going to go lower. So when VIX is up, the cost of insurance is higher. And when VIX is down, the cost of insuring a portfolio is lower. Really simple. All right, and this is also important. Similar to the S&P 500, the VIX index is not actually traded. But you can't go out and buy SPX. You can recreate the SPX, but you can't just go out and call your broker and say, hey, buy me one S&P 500. You can buy SPY, you can buy calls, you can buy futures, but you can't just buy SPX. So what the VIX is essentially an estimate of implied volatility on the S&P 500 options. It has a constant duration of 30 days. So constant duration means that it wants to mimic a portfolio with 30 days to expire constantly. So today, the VIX has 30 days to expire. Tomorrow, the VIX has 30 days to expire. Next week, the VIX will have 30 days to expire. That is how it trades. All right, it is quoted as a price, but it's actually a percent. So, volatility, despite not being spoken as a percent, is always a percent. So VIX of 10 is actually 10% annualized volatility, which means that over the next 30 days, the VIX is going to move at a 10% annualized rate. So right now, if I pull up VIX, the VIX is 16.91, right there. See that? So right now, the market is saying for the next month, the market is going to move at an annualized volatility of 16.91%. That's what that means. Really simple. The VIX negatively correlates with the SPX. So as you can clearly see, right, in the last week, the S&P tanked and the VIX has rallied. So generally, when the SPX is up, the VIX is down. And when the SPX is down, the VIX is up. When, which makes sense, right? Like when markets are calm and rising, we don't want as much protection. When we get a big move like we had this week, the last couple of weeks, we're recording this on 8/8/2019, then everybody wants volatility protection. It's just the way it is. And so what you have on your hands is just VIX tends to move opposite of the S&P. Now, if it doesn't do that, that does tell us something. All right. So a question from Kirby is, would you estimate, say, about an 80 to 85% correlation VIX versus SPX? Negative, yeah, it's about that. It's about 83% negatively correlated. So that is the VIX. And so just real briefly, VIX futures. All right, they trade out 8 months plus there's weeklies. Each month trades independently, all right, which is very different than S&P futures. And, they're in and I'm going to talk briefly about Contango and backwardation, but they're used primarily as a hedge. And so what I mean by independent is I'm going to pull up the futures term structure here. This is VIX futures term structure. And what I want you to notice is that, it clearly moves with, with volatility. So like, I can show you, right? Volatility is up, VIX is up, VIX is higher. Volatility is really high. You can see how it moves, right? So here's the term structure. Here's August, September, October, November, December. But, you know, just briefly take a look at the price of August, right? So VIX is 24, August is 21. VIX is 24, December is 1850. Let's go to today. Right? VIX is 16.91. August is 1810. So August fell more than 3 points. VIX is right there. There's the VIX price. You can also see it right here. And then you can see that each of these is a different month. Question is, where are you seeing VIX? So again, August went from, on the 5th, 2183 to today, 1815. So it fell, you know, almost 4 points. Meanwhile, December fell from 1847 to 1741. So December fell less than a point. So the major thing to understand is that each month moves, they move correlated to each other, right? Like, you're not going to see December up and August down. But what you will see is August move a lot more than December moves. That's how the futures move with VIX. And that's really a really important thing to understand when you're trading VIX and managing VIX. So this formation that you are seeing, where you've got the VIX cash index at 1430, the front month at 15, the second month at 1620, third month at 1650, fourth month at 1680. So the cash is below the first month, which is below the second, and so on and so on. This is called Contango. Right? This formation is called Contango. And this is what VIX hangs around in about 80% of the time. And when VIX is like this is when, who here has some sort of like system they trade? Or who here, you know, I like to sell iron condors. And here's my risk control, and here's this, and here's that. You know, they can lay out kind of a plan. VIX spot is cash. Yes. Question was, is VIX spot cash? Yes. The cash VIX is the same thing as VIX spot. So when we have this formation in Contango, all those system trades, all those trades that trade on probability work. You know, there's a couple of guys that have an internet TV show, and they, you know, they have all these, like, you know, they like to just sell options. And, you know, when the VIX looks like this, that stuff is going to work most of the time. Not all the time, but it's going to work most of the time. But here is what we call a backwardation, or the VIX being backward. And when the VIX is backward, that means the spot VIX is trading at a premium to the front month, which is trading at a premium to the next month, and so on and so on. You can see spot is 25.5. Front month is 24.25, 22, 30, 21.80, 21, and going all the way out to 20.5. Right? This is Contango. This is backwardation, excuse me. And when the VIX is backward, all of your best laid plans tend not to work. Right? And interestingly, the market has a highly negative return. When the VIX is backward, the market has a negative to flat return. So if all you did was go to cash and not trade or own stocks when the VIX was backward, you would make more money than someone who bought and held and just kind of closed their eyes through sell-offs. And this formation only happens when we're in the middle of a major sell-off. So getting back to my curve, you can see over a couple-day period, the market had really negative returns. But now, what kind of formation is this? When VIX is backward, the market has a negative return. How come? Well, I think the VIX being backward is indicative that the market is in a major stress period. And there is a rush for protection. When people are rushing for protection, why are they rushing for protection? Because they're scared. When the market is scared, it tends to go down. So, this formation, this is what I call a transition formation. And what's going on? Well, the cash, the spot, is below the whole curve. But other than August, the rest of the curve is in backwardation. So we have a little contango, right? You see that little contango, but then a lot of backwardation. But all of it is trading above spot. So that is telling you that we're in transition. We don't know whether we're going to look like this in a couple of days, or go right back to this. That makes sense? Good. So normally, when the VIX is a contango, my favorite trade in VIX itself, and I'm not going to talk too much about VXX today, is a convergence trade. So how does a convergence trade work? Well, a convergence trade, I want you to notice backwardation, right? So if the VIX stays at 985 in this case, and I sell a Jan future at 1332 and a half, at 1332, where is the Jan future gonna settle? If VIX doesn't move for the next, at this time it's November, if the VIX doesn't move for the next 3 months, it's going to settle 95. So if that happens, how much money would I make if I shorted the future? About $3.50. All right. So you're talking that a VIX, you'll make $3.50. Now so all you're betting is that if I sell this option here, that over time, it will fall slowly till it hits this. Right? So 1335 minus 985 is about $3.50. So if you're going to trade short, and I'm going to just briefly talk about that because, that's where we are. then the best way to do it is long put spreads. And I'm going to just kind of really short, you're basically simulating a future, but you're risking less than just shorting a future. And it's a convergence trade. So let me show you this. The Jan options, the VIX is 985. Should I be able to buy a $12 put for $1? If VIX is 985, and should I be able to buy a $12 put for $1? What do you think, guys? Should you be able to do that? Under normal circumstances, the answer is no. If VIX was Apple, right? So Apple's trading 200. Should I be able to buy a 210 put for $5? No. So the key to this trade is that right now, January is 1332. All right. All right. Right now, VIX is 1330. January, the Jan future is 1332. All right. So if I buy a $12 put for $1, the reason why I can do this is because the Jan options are pegged to the future, not to the underlying spot index. So because there's that separation between spot, which is 1332, and the cash, which is 985, I can theoretically buy a $12 put for $1, and if the VIX stays where it is, that Jan future is going to slowly fall. And lo and behold, I will make money on this trade. But what's my big bet? My big bet is not that volatility is going to fall, right? When you buy a put in Apple, you're betting that the underlying is going to fall. In this trade, I'm betting that the underlying is going to stay where it is and the future is going to fall. So if the future falls and the underlying sits, my $12 put is going to be worth how much? If in January the VIX settled 985, well, the long puts caps my risk, right? So if VIX settles 985 and I buy the $12 put for $1, how much money do I make? This should not be hard. Simple math. What is 12 minus 985 minus $1? What's the math there? Right, Joe. I'm going to make $1.15. And in a normal environment, this is the kind of trading we kind of teach in VIX. However, it's not a normal environment. All right. What's going on? Vol is high. Vol is real high. It's moving around. The vol of vol is high. So VIX is moving around a lot, which means VIX itself has a lot of volatility. So now that volatility is moving around, how do you hedge yourself and how do you make money? Right? Because two things are going to happen. Right? Vol could go up more. It could go up and up and up. It could go to the moon. Right? There's no real upper bound to volatility. It could go to 200 or 300. But at the same time, remember that first slide. Where is the VIX eventually going to go? Where's the VIX eventually going to go? Back to its mean. So, right, there's going to be reversion, but when will that mean reversion be? When will that mean not back to spot? It'll go back to its mean, which is 15, 16 or lower. Yeah, you don't know when. So we need to figure out how to trade long and short at the same time. So, I'm gonna skip a little bit of how to be long, and let's go right into how to trade right now. And I want to start with hedging. All right. So let's pull up the options on VIX. And we'll go to August. All right. And the August future is 1805. It says 1805 right there. See that? And if I pull up my futures term, $18.05. So I have a big long portfolio or I have a short vol portfolio. Who here likes to sell options? I'm going to guess 80% of you. Yeah, y'all love selling options. So is an environment where where VIX is really moving around good for your short options? No, it is not. But here's the beautiful thing. When VIX goes running, big institutional paper loves to chase volatility. But they like to chase it way up. So I want you to notice something. Look how much open interest is on the 25 calls. Look how much is on the 20 calls. And the 30s. Those are all the heavy strikes on upside. If I go to September, I mean, look how much open interest on the 30s and like even the 42.5s. Big institutional money likes to go after way out of the money VIX options. Why? Because they're not worried about a 5% sell-off. Big institutional money doesn't care about a 5% sell-off. Does not affect them. What do they care about? They care about the VIX exploding. 20% sell-offs. So what do they go after? They go after the 30 calls. They go after the 35s, they go after the 40s, they go after the 50s. I mean, look how much open interest is on the 37.5s here. You see that? 175,000 contracts. So what does that end up doing to VIX options? Well, right now, remember, if I pull up the futures term, and I just go to yesterday, the VIX was 1930 at the close yesterday. And on Monday, it was 2183. So as early as 2 days ago, 20 was the major option. The August 20 calls, which have about 2 weeks to expire, cost me $1.05. Right? Well, and this is important. Looking at a 1-month stock chart, the absolute high when we were at, when we were down 110 on Monday was the VIX didn't touch 25. And yet I can put on a 20. Look, the 20 calls are $1.05. The 25 calls are 40 cents. I could put on a 5-point vertical for 60 cents. You know how cheap that is? It's really cheap. And if I go to September, it's even worse. The 20 calls are $1.55. The 27 calls are 60 cents. So I can buy the 27 call spread for less than $1. So the trades that are going to work as a hedge are call spreads. Even in a market where vol is really high, because out of the money options move so much, you can hedge really cheaply using VIX options. Does that make sense? Good. So now what if I want to short the VIX? What do I do if I don't buy this sell-off? What can I do? That's next on my slides, right? We think VIX is going to go down. How? Well, so here's the problem. Someone said buy puts. Well, maybe, but let's take a look at how expensive some of these puts are. And the problem you have is that 80 cents for the 16 puts is a pretty big gamble on the VIX getting back below 15. Question is, do I like VIX options better than VXX options? I would say this. I use both. I like VIX options for trading upside moves a lot better than I like VXX options. And then on the downside, there can be trades in both. So right now, if I look at August, look at the implied volatility here. It's still way over 100. But I can find areas where I can maybe make volatility work in my favor. And how do I do that? I like put spreads and put 1x2s. So here was a trade that I liked yesterday. What is VXX? Sorry, I want VIX. I liked buying the 17 puts for 80 cents. Selling the 15 puts at, 22 and a half. And then buying the 13 puts for less than $1, less than a nickel. So that's, let's say, 82 and a half. So we're going to say 85 cents for the 17s and 13s and 22 and a half. 40 cents for this butterfly. I'm going to use Thinkorswim here because I think most of you are probably used to Thinkorswim. By the way, Thinkorswim is kind of hard to use for VIX. But I want to look at this trade now. How did this work out? I did the 17, 15, 13. So I made 20 cents on that. No, we're talking about, question is because you think market's going, no, we're talking about ways of playing volatility spikes backing off. So I bet 40 cents to make 60 cents. What's my overnight return? What's my overnight return on that? Not bad, right? 50%. I could have gotten cute and done like the 13 and a halves. That would have cost me like 45. And it's up nicely. Maybe 40, something like that. 45. And so it's really up pretty nice. And that's the key. I like to use implied volatility to my advantage because of two things. One, VIX futures move a lot slower than the VIX itself. So that butterfly is going to tend to work over time. And two, what's going on with implied volatility, even on downside options when VIX is exploding? It's way up. So when implied volatility starts to fall, I'm going to be in good shape. So let's look at a vol graph for VIX options. This is yesterday. Vol was about 107. Here it is today, about 100. That's a nice vol move. And look at the implied volatility of these options now. The 15s are about the same. The 17s have gone up. And the 13s are about the same. So that's a trade that I'm looking to do right now. When I'm trading my fund, the only big difference between what I just showed you and what I do is I don't bother with the 13 put. I just do what I call a put 1x2. That was a balanced butterfly, yes. It was, the ones we looked at was the 17, 15, 13. So now, what about a non-directional? What do you think? Who thinks they don't know if the VIX is going to go up and they don't know if the VIX is going to go down? In the next week or two. All right. So I've talked to you about two things, right? One, VIX call spreads are they cheap or expensive? Cheap. What about the vol on downside? If the VIX moves down, what's going to happen to vol? It's going to fall. So it takes some work, right? But I can build a trade. What if I did this cute little butterfly that I had in there? You know, I've got this cute little butterfly, right? What if I did this cute little butterfly with a short vertical, with a long vertical? So remember, I only paid 40 cents for my butterfly, and my 20, I do like a 2024 vertical, and it's going to cost me, you know, or a 2023 even. So I'm going to pay 90 cents. Oh, whoops, wrong one. So when I do this, I'm going to end up paying 90 cents for this entire package. And what I like is that it's a nice gamble on something happening. Now, truth be told, when I do this trade, I make my downside not in VIX, but I make my downside in VXX. That is how I do it and how we do it in the Vol newsletter and when we trade at Option Pit. But I don't want to spend, we don't have time for me to spend an hour talking VXX. So what I can tell you is that you now have a trade where when the VIX eventually falls, you make your money. But if it blows up, you're hedged. And I can change this however I want. I don't need a big vertical to hedge. The 22 works. Did they reduce the leverage on VXX with the new unit? No. So this is just one of the trades that I can do that's a non-directional, but makes me pick a side. But once it picks a side, and here's the beauty. So let's say vol runs hot and we get back to 21. What do you think I'm going to do? I know the trade expires in 2 weeks. I'm showing you a brief example. Question. So if VIX goes to 21, what do you think I'm going to do? No, I'm going to sell my call spread. So if VIX goes to 21, my call spread is going to be worth, this package here for the 2022 and my butterfly is 35 cents. If VIX goes to 21, my call spread will be worth 80 cents. So if I sell the 2022 call spread at 80 cents, all right, how much money have I made on my call spread? 80.80, 0.80. 80 cents. My call spread will be worth 80 cents. So I'll have paid for, but here's the beauty. How much did I pay for the whole package? Guy said, oh, I make 45 cents. How much did I pay for the whole? I paid 70. So if I sell at my call spreads at 80, now what do I have left? I own, if I sell this, I'm going to show you this. Watch this. All right. So can I lose money anymore? I have a free butterfly. I was just estimating based on the delta what it'd be worth if it goes to 80 cents. Question is, how'd you get to 80 cents? It's the delta of the spread. Right? The spread is an 11 delta, and VIX is 17. So if we go to 2021, it's a 5-point move. That's 50 cents. It costs 35 cents. So now I've guaranteed myself money, and if we tank, if vol tanks, I'm in a position to absolutely clean up. And if you're wondering, is this what you guys actually do at Option Pit? The answer is yes. Yes, it is. So with that, I want to show you I don't know if you guys know this, I'm Cramer's VIX expert. So for 97 bucks, I'm going to give you our 4-hour VIX primer, which is going to teach you everything about VIX. It's going to teach you a ton about VXX. It's going to show you VXX trading. It shows you VXX trades I would execute. It shows you VIX trades that I'd execute, all sorts of fun things. I'm going to give you a month of our volatility newsletter so that you're able to track us. And we meet. So the vol newsletter puts out a trade once a week, and we have a live meeting once a week where we literally teach you what we are doing and why. And on top of that, you will get a free 30-minute phone call with me, and we will hit your pain points. You know, in this 30-minute call, I will make a difference for you. All right? I'm going to listen to what you're doing. I'm going to give you some actionable things that you could do right now, and then I will, maybe tell you about some steps that you can do going forward. This is an absolutely amazing package. And if you already have the VIX primer, I will let you pick a different class in our course book. It's for 97 bucks. You really can't beat this deal. And you can even see me, Jim Cramer, talking about me on television. So it's really just a great course. You get a great month of live education. I know we have vol newsletter subscribers in here. They can tell you how good the newsletter is. And then you get a 30-minute session with me for 97 bucks. Right? I'm sorry, but I taught you $97 worth of stuff right here. If you end up going through it and you don't think it's worth it, I'll give you your money back. But you will. So this offer is good until Saturday. And then I am deleting this page. I will take questions for about 2 minutes. What questions do you have for me? Does this include trading UVXY and SPXY? Yes. Only risk in this trade is vol sits for a bit. Yeah, typically when VIX is moving around, it stays moving around until it picks a direction. But yes, that is the risk here, right? There's no such thing as a free lunch. There's no free trades. Your risk is if it sits here, but you only paid 70 bucks for the package. Will it be recorded, your 30-minute session or the vol newsletter or this webinar? This webinar is recorded. The 4 hours is recorded. It's a pre-packaged course. Are there VIX futures options? There are not. But the VIX options underlying is actually the futures. Yeah, Kirby, we need to get you back in the fold. So please do. Do you recommend putting on, say, calendar or fly every week just to be? I don't know. I think it depends on other factors. The whole idea of doing the same thing every week is ridiculous. Ask any professional whether that's their approach. The answer is no. We believe in what we call conditional trading. What is the market giving you? Take it, instead of trying to force your own trade on it. And that is what we're going to teach you, Bob. Course will be ready as soon as you register. Vol newsletter, they meet on Wednesdays, I believe. But you'll have access to the trades that we have on right away. All right, I'll take one more question. Thank you, Kirby. That is a really nice endorsement. He said, I would say that you have a better vol understanding than 95% of traders out there after this course. Do you recommend live vol? Marvin, give me a call on that. Actually, I gave you a call this week. Give me a call back and we can chat about it. Done, John. All right, everybody. If you got something right here, www.optionpit.com/Kramer. Okay, guys. I want to thank everybody for coming. I appreciate you guys spending the close to an hour, and I hope you have a great night.